AppLovin reported rapid second quarter growth, but APP still fell 19.7% in the next regular session. Revenue reached $1.924 billion, up 53% year over year. The central question is why strong operating results did not clear the market's already elevated bar. This is educational research, not financial advice. Please verify all data independently. Before the report, the selected consensus listing pointed to about $1.95 billion in revenue and diluted GAAP earnings per share of $3.76. AppLovin's own outlook called for $1.915 billion to $1.945 billion of revenue and $1.615 billion to $1.645 billion of adjusted EBITDA. Investors were focused on whether Axon-led advertising gains could keep producing upside beyond those expectations. The quarter was mixed against expectations. Revenue reached $1.924 billion, up 53% year over year, but modestly below the roughly $1.95 billion cited expectation. Diluted GAAP earnings per share were $3.76, in line with that expectation, and up 57% from the prior year quarter. AppLovin released its results after the August 5th close, and APP fell 19.7% in the August 6th regular session. Revenue remained within management's own range, but it did not provide the upside many investors expected. Q3 guidance still called for growth, yet it did not fully reset the market's demanding expectations for AI-led advertising expansion. AppLovin does not disclose a standalone AI revenue number. It says substantially all revenue comes from AppLovin Ads, an AI-powered demand-side advertising solution, while Axon AI is its recommendation system. That means investors must judge the AI thesis through broader operating evidence, such as advertiser returns, retention, pricing, and expansion beyond gaming. The financial profile remained unusually cash-generative. GAAP net margin reached 66%, adjusted EBITDA margin reached 84%, and free cash flow was $863.3 million. AppLovin also used $551.3 million for share repurchases and withholding, which supports per-share economics, but does not remove the execution question around future advertising model performance. For the third quarter, AppLovin guided to $2.055 billion to $2.085 billion of revenue and $1.710 billion to $1.740 billion of adjusted EBITDA. Those ranges imply continued sequential growth. However, the 83% adjusted EBITDA margin guide is below the 84% reported for Q2, which kept attention on the quality of the next growth step. Management's operating challenge is clear from its own disclosures. Make advertising recommendations more effective and predictable while expanding into newer markets such as e-commerce. Axon AI matters because recommendation quality can affect advertiser returns and spending. The company does not provide a direct Axon revenue figure, so the evidence must remain operational rather than purely narrative. Several core operating measures improved. Revenue, net income, free cash flow, and margins all increased from the prior year quarter, and Q3 guidance calls for more sequential growth. At the same time, revenue was modestly below the cited expectation. Q2 EBITDA was fractionally below the low end of company guidance, and the Q3 margin guide stepped down to 83%. Before earnings, the thesis depended on Axon-led performance advertising sustaining rapid growth and strong cash generation, while AppLovin entered new advertiser categories. After earnings, the financial evidence still supports that operating case. The proof burden is higher, though, because investors now need repeat evidence that model development and e-commerce expansion can produce further outperformance. Bulls can point to 53% revenue growth, $863.3 million of free cash flow, an 84% adjusted EBITDA margin, and a Q3 outlook for continued growth. Bears can point to the absence of a revenue upside surprise, the lack of separate Axon revenue disclosure, and the uncertainty around e-commerce adoption. The results strengthen the business case while raising the standard for the next report. The most useful checkpoints are revenue and adjusted EBITDA against management's Q3 ranges, plus whether the company maintains the 83% margin guide. Investors should also watch for evidence of advertiser adoption outside gaming, especially in e-commerce. Free cash flow conversion and future repurchases remain important capital allocation signals. AppLovin earns high marks for profitability and strong marks for headline results and AI momentum. Guidance and execution outlooks score lower because expectations remain elevated, and the next stage of expansion needs more proof. The verdict is strong operations, but the market now demands renewed upside rather than simply continued growth. Thanks for watching. Like, share, and subscribe. Then visit AIStockshub.com.